In recent months, social media platforms in Indonesia have been flooded with hashtags like Dako Indonesia Jelap, Dark Indonesia, and Kaburaja Dulu, just run for now, reflecting growing public anxiety about the country's economic future. From viral posts about rising living costs to heated debates over government policies, these hashtags capture a nation grappling with uncertainty. But behind the online outcry lies a deeper story, one of falling tax revenues, mounting debt, currency instability, and ambitious yet costly government programs. As Indonesia stands at a crossroads, the question on everyone's mind is this: is the country heading toward economic recovery, or is it on the brink of a crisis? This article delves into the key challenges shaping Indonesia's economy and explores what lies ahead for Southeast Asia's largest nation. Indonesia, Southeast Asia's largest economy, is facing a series of significant challenges that have raised concerns about its economic stability. From falling tax revenues and mounting debt to controversial government programs and persistent corruption, the country is at a critical juncture. This article examines the key issues shaping Indonesia's economic landscape and explores what lies ahead. Indonesia's economic challenges are underscored by a significant shortfall in tax revenues, which fell below target in 2024, reaching less than 8% of GDP. This marks a troubling trend for a country that has historically struggled to broaden its tax base and improve compliance. The tax-to-GDP ratio in Indonesia is already one of the lowest in the region, lagging behind peers like Thailand 16% and Malaysia 12%. The recent decline has been attributed to weak economic growth, reduced consumer spending, and inefficiencies in tax collection. As a result, the government's ability to fund critical programs and infrastructure projects has been severely constrained. Compounding the problem is the looming debt maturity in 2025, with over 800 trillion rupiah, approximately $53 billion due. A significant portion of this debt is owed to foreign creditors, exposing Indonesia to exchange rate risks. If the rupiah continues to weaken, the cost of repaying this debt could escalate, placing additional strain on the national budget. The government's fiscal challenges are further exacerbated by the need to fund ambitious social and infrastructure programs, such as the Free Nutritious Lunch Initiative and the plan to build 3 million homes by 2025. These programs require substantial upfront investments, but with tax revenues falling short and debt obligations mounting, the government has been forced to make difficult trade-offs, including cutting infrastructure projects in the new capital city, IKN, Ibu Kota Negara. Economists warn that Indonesia's fiscal sustainability is at risk if these issues are not addressed. The country's debt-to-GDP ratio, currently around 40%, is still within manageable limits, but the combination of rising debt and declining revenues could push it into dangerous territory. Moreover, the reliance on foreign borrowing has made Indonesia vulnerable to global financial volatility. Any sudden shift in investor sentiment or a tightening of global liquidity could exacerbate the situation, making it harder for the government to refinance its debt. To address these challenges, the government has explored various measures, including cracking down on tax evasion and expanding the tax base. However, these efforts have yet to yield significant results. The recent push to introduce a third round of tax amnesty aimed at encouraging taxpayers to declare previously undisclosed assets has faced criticism for being too lenient and failing to generate substantial revenue. Meanwhile, the prospect of raising taxes or cutting subsidies remains politically sensitive, given the potential impact on public sentiment and economic growth. Ambitious government programs, a double-edged sword. One of the government's most ambitious initiatives is the Free Nutritious Lunch program, designed to improve child nutrition nationwide. While the program has noble intentions, its financial implications are staggering. Over the next 5 years, it could cost hundreds of trillions of rupiah, with additional expenses tied to importing millions of cows to support the initiative. Critics argue that the program's benefits will take years to materialize, leaving the government to shoulder significant upfront costs without immediate economic returns. Another major initiative is the plan to build 3 million homes by 2025. While this addresses a critical housing shortage, the funding required has led to cuts in other areas, including infrastructure projects in the new capital city, IKN. These cuts have sparked concerns about the future of IKN and whether the government can effectively balance competing priorities. Currency weakness and the DHE policy. The Indonesian rupiah has been under sustained pressure in recent months, weakening to 16,500 against the US dollar, its lowest level in years. This depreciation reflects a combination of domestic and global factors, including rising US interest rates, a strong US dollar, and concerns about Indonesia's economic fundamentals. The rupiah's decline has significant implications for the economy, particularly for sectors reliant on imports, foreign debt, and global commodity prices. In response, the government introduced the Domestic Holdings Exemption policy, aimed at stabilizing the rupiah by encouraging businesses and individuals to hold more rupiah instead of foreign currencies. The policy provides tax incentives for those who keep their funds in rupiah-denominated accounts, with the goal of reducing demand for US dollars and easing pressure on the exchange rate. However, the DHE policy has had limited impact so far, primarily because it is not mandatory. Businesses and individuals are not required to convert their US dollars to rupiah, and many continue to hold foreign currency as a hedge against further depreciation. The rupiah's weakness has had a ripple effect across key industries. For example, the palm oil and coal sectors, which are major contributors to Indonesia's export earnings, have faced challenges due to fluctuating global prices and rising production costs. While these industries benefit from a weaker rupiah in terms of export competitiveness, they also face higher costs for imported machinery, fertilizers, and other inputs. Small and medium-sized enterprises, SMEs, in these sectors are particularly vulnerable, as they often lack the financial resilience to absorb these additional costs. Many SMEs are also struggling to access credit, as banks tighten lending standards in response to economic uncertainty. The DHE policy's limited effectiveness highlights the broader challenges of managing currency stability in a globalized economy. Indonesia's reliance on foreign investment and external financing makes it particularly sensitive to shifts in global investor sentiment. For instance, as US interest rates rise, investors are increasingly drawn to dollar-denominated assets, leading to capital outflows from emerging markets like Indonesia. This has put additional pressure on the rupiah and complicated the government's efforts to stabilize the currency. Moreover, the rupiah's depreciation has implications for Indonesia's foreign debt, a significant portion of which is denominated in US dollars. As the rupiah weakens, the cost of servicing this debt increases, straining government and corporate finances. This is particularly concerning for state-owned enterprises, SOEs, and large corporations that have borrowed heavily in foreign currency. If the rupiah continues to weaken, it could lead to a vicious cycle of rising debt servicing costs, reduced investor confidence, and further currency depreciation. Looking ahead, the government faces difficult choices in addressing currency weakness and its broader economic implications. While the DHE policy is a step in the right direction, more comprehensive measures may be needed to restore confidence in the rupiah. These could include tightening monetary policy to curb inflation, improving the business environment to attract foreign investment, and implementing structural reforms to boost productivity and competitiveness. Corruption scandals, a persistent challenge. Corruption remains a significant obstacle to Indonesia's economic progress. A recent scandal involving Pertamina, the state-owned oil and gas company, highlights the issue. The company has been accused of mixing subsidized fuel, Pertalite, with higher-grade fuel, Pertamax, resulting in losses of trillions of rupiah and eroding public trust. As consumers shift to private competitors, Pertamina's declining revenues could further impact government income. The rise of Danantara, promise and peril. In an effort to streamline the management of state-owned enterprises, SOEs, the government established Danantara, a holding company tasked with overseeing SOE dividends. While the initiative aims to improve efficiency, concerns about political influence and corruption have emerged. Many of Danantara's board members have ties to politicians, raising fears that the organization could become a vehicle for graft. Similar entities in other countries, such as Malaysia's 1MDB, have been marred by scandal, underscoring the need for robust oversight. Foreign investment outflows. A vote of no confidence? Foreign investors have been withdrawing from Indonesia at an alarming rate, with tens of trillions of rupiah exiting the country's stock and bond markets in recent months. This trend reflects growing uncertainty about Indonesia's economic prospects as investors seek safer havens amid global volatility. The outflow of capital has further exacerbated the challenges facing businesses and policymakers. The China factor. Competition and consequences. China's economic struggles are also having ripple effects in Indonesia. As Chinese companies face difficulties at home, many are expanding into Indonesia, establishing factories, distribution networks, and retail stores. While this influx of investment could boost economic activity, it has also intensified competition for local businesses, particularly SMEs. The long-term implications of this trend remain uncertain, but it underscores the need for policies that support domestic enterprises. Prabowo's economic policies. A path forward? Amid these challenges, there has been growing discussion about the economic policies proposed by Indonesian President Prabowo Subianto. Prabowo has advocated for increased infrastructure spending, support for SMEs, and measures to boost economic growth. While these proposals have garnered attention, their effectiveness will depend on implementation and the broader economic context. A precarious future. Indonesia stands at a critical juncture with its economic outlook clouded by uncertainty. Falling tax revenues, mounting debt, and ambitious yet costly government programs have created significant fiscal pressures. Corruption scandals, foreign investment outflows, and increasing competition from Chinese businesses further complicate the landscape. These challenges, if left unaddressed, could undermine Indonesia's growth trajectory and exacerbate economic instability. The government's ability to navigate these turbulent waters will be pivotal. Tough decisions lie ahead, whether to implement structural reforms, improve tax collection, or attract foreign investment. The stakes are undeniably high. The choices made today will not only determine Indonesia's economic resilience, but also shape its future for generations to come. As the nation grapples with these pressing issues, one thing is clear: Indonesia's path forward will require bold leadership, transparency, and a commitment to sustainable development. What are your thoughts on the challenges facing Indonesia and the steps needed to overcome them? Share your insights in the comments below, and don't hesitate to share this article to spark a broader conversation about Indonesia's future. Together, we can explore solutions and envision a brighter tomorrow for Southeast Asia's largest economy.